This is level 1 of the CFA program, the topic on corporate issuers, and the reading on sources of capital. Just a reminder, this is really the second paired reading with the uses of capital. Now we have the sources of capital. Let me go ahead and remind you that in uses of capital, we examined the left-hand side of the balance sheet, what used to be called capital budgeting in the old readings. Now we're going to look at the right-hand side of the balance sheet, what used to be called capital structure in the old readings. But now this sources of capital is going to include both short and long-term sources of capital. So we're going to refer to this kind of as working capital management and capital structure. And you'll see that as we look through these learning objectives. So types of financing, short and long term, whether we get those in the primary or the secondary market as sources of liquidity. And then we'll take a look at some choices of short-term funding. So this is a pretty short chapter with just 4 LOSs, and it's entirely descriptive. So we can put our financial calculators away during the next several minutes. So let's go ahead and describe sources. And there you go. Look at those first 2 arrow points, short-term sources and long-term sources. So the short-term includes sources from operating activities. And so I want you to think of the top right portion of the balance sheet. So accounts payable, short-term loans, and short-term instruments. Long-term, of course, includes bonds. Those are the fixed income securities. And then equity, common equity, convertible bonds, and preferred equity as well. One of the interesting parts about this LOS, and I think this is a really, really good potential exam question. Let's read that first line together. Every source of capital has different risks. So let's go ahead and start with internal financing. I mean, of course, this would be the obvious way that every business, and in fact every household, would like to finance its spending or its capital investment, generate internal financing. And so, of course, remember what we did in the uses of capital reading. We talked about investing in projects that have positive net present values. Remember that those projects have positive net present values because they're expected to generate lots and lots of repeatable and sustainable operating cash flows. Well, wouldn't it be awesome if those operating cash flows were enough to finance all of the stuff that's going on the left-hand side of the balance sheet? So what do those teardrops points say? Generate large after-tax operating cash flow. We talked about that at length in the last reading. Increasing working capital efficiency. All right, so this is an important part of this particular reading. Remember, working capital, we've got current assets on the top left, we have current liabilities on the top right, and we have cash flows coming in and out according to the terms of all the transactions that we make as a business. And so that increasing working capital efficiency means primarily linking those cash inflows and those cash outflows as they occur in the short term. And then if you look at that last teardrop point, oh boy, let's scratch our head for this one. Converting liquid assets into cash. I guess that could mean, of course, some of our investments in financial securities. Those are pretty liquid, but let's hope it doesn't mean converting our long-term assets into cash. All right, types of financing methods. So let's go ahead and start with financial intermediaries. And I'm guessing that you know this probably just from your regular old knowledge of the way businesses work, right? An uncommitted line of credit and a committed line of credit. These are formal relationships with financial institutions in which you really need to just pick up the phone and say something like, hey, I need some money, and the bank will say, okay, here it is. Or they'll say something like, okay, whenever you need the money, then go ahead and here it is. Revolving credit arrangements, so you can draw this down or you can pay back those amounts periodically. Revolving meaning that it can go one way or the other. Secured loans, of course, you have to have some kind of collateral, and typical collateral includes things like equipments and machinery and buildings. And then web-based lender, small amounts in in offering loans. So remember here, I went a little bit too quickly. So financial intermediaries can provide businesses with what I want to categorize as maybe relatively small or smaller sources of capital. For larger sources of capital, we're probably better off going to the capital markets. Commercial paper, these are short-term unsecured paper or borrowings, and these are issued by super large corporations, and they do this in maturity days of usually 270 or less. And the reason that these large corporations can get away with short-term unsecured borrowing is because they have good or great credit ratings. Remember that these commercial papers are rated by the agencies, and commercial paper is a super terrific way for these large businesses to manage that mismatch between cash inflows and cash outflows. So think about it this way, cash flows, they go way up and they go way down. And so when the cash flows are way down, boom, the corporation can issue commercial paper and then make certain that it can meet all of its short-term obligations. And then when the cash flows swing back up, then they repay that commercial paper. Long-term debt, these are fixed coupon rates and floating coupon rates. These are bonds that are longer term. They could be notes in maturities of 1 to 5 or 10 years. Remember that when a business issues long-term debt, it makes an explicit promise to pay interest and principal. And remember that long-term debt is a legal and binding contract. Common equity, of course, this represents the ownership. These are the common shareholders. What did we say in that previous reading? That the goal of the business is to maximize the value to the owners. And so the goal of the business is to make certain that we make all decisions, but primarily capital budgeting decisions that swell the equity portion of the balance sheet. Of course, when corporations issue common stock, they make a vague promise, not an explicit promise. They make a vague promise that says something like, here, send me your capital, I'll distribute ownership shares to you, and I'll do my best to invest in positive net present value projects, and I'll do my best to pay you a dividend and give you the opportunity to go to the floor of the New York Stock Exchange to generate a capital gain. But I don't have to do those things, right? It's a vague promise. It's not a legal and binding contract. Preferred stock usually comes with a promise of a fixed dividend payment. It doesn't have to be fixed, but it's usually a fixed dividend payment. So because of that nature, it shows up in the equity portion of the balance sheet. But a lot of people and a lot of good financial analysts consider these to have characteristics of both debt and equity. And then some other hybrid securities to make a bond issue and a stock issue either more or less attractive: convertible bonds and convertible securities. And of course, there are some other hybrid securities with embedded options in there. All right, how about if we compare, watch this, firm-specific considerations to general economic considerations. So we'll go through both of these. So remember what we're trying to do. On the right-hand side of the balance sheet, we're trying to determine, should we borrow in the short term, should we borrow in the intermediate term, or should we borrow in the long term? And how should we do that? Especially that decision over in the long term. Is that going to be debt or equity? So we need to consider company size. Look at that last sentence there. Larger companies can also rely on internal financing. Think of a company like Procter & Gamble that has tons and tons of consumer products, plus a slew of other kinds of products, and it has cash flows coming in all the time. And so it's possible that a company like Procter & Gamble can rely on internal financing. Now, not all the time, because companies like Procter & Gamble issue lots of commercial paper. So the timing element of this is super important in addition to the company size. The level of risk with these assets. So when we talk about asset risk, we're talking about the ability of those assets, which means the product lines generated by those long-term assets, and what is the volatility in their cash flows. So notice that first sentence there. Companies with volatile cash flows rely on equity financing way more substantially than they do debt financing, because remember, even if it's a floating rate payment or a fixed rate payment, that's an explicit promise. It's a guaranteed promise to make those interest and principal payments. And so link that with a high degree of business risk. Assets for collateral. Sometimes assets are unique. They're super specialized. They might be intangible and they might not be valuable as collateral. Public versus private equity. Of course, publicly traded firms have shares that are traded, either in the over-the-counter market or on the floor of the New York Stock Exchange. So those shares are pretty liquid. Private companies, and maybe these private companies are larger, and maybe their shares are relatively liquid, but they'll never be as liquid as if they trade on an exchange. Now, of course, the liquidity in that private market depends on how efficient that company is, how efficient that private company is. And if there are high degrees of efficiency, then it's likely to attract attention from the private equity market or some other markets that are out there, in which firms come in and maybe make an offer to buy parts or all of that company. So liquidity in the private sector is way less, but it depends on the efficiency and how much interest there is from other parties. Remember a few moments ago I did the linking here. So this is what I'm talking about, asset liability matching. Businesses will try to match the maturity structure over here with the maturity structure over here. So if we're trying to finance accounts receivable over here, we'll try to match them with a similar size and amount of accounts payable. Debt maturity structure. So this goes back to some of our economics discussions and the yield curve. Remember that we're faced in general with an upward sloping yield curve when investors expect the economy to expand. And so we're most oftentimes faced with a scenario where short-term rates are less than long-term rates. So if we issue a long-term fixed income security, then we better be aware that we're paying a higher interest rate, but that money better go to something that's going to pay off over the long term. Currency risk, boy, we could have an entire reading, and in fact we do in level 2 and level 3, entire readings on currency risk and how changes in exchange rates impact both short-term, so working capital management, and long-term capital structure management. And so what a lot of companies try to do is they'll say something like, oh, if I have, let's say, 100 Canadian dollars in accounts payable, wouldn't it be nice if I had 100 Canadian dollars in accounts receivable? And if we match those currency positions, then we have substantially reduced, if not, in fact, in a perfect world, eliminate currency risk. Oh boy, agency costs. This is a great topic for me. I love telling students about the natural battle between the shareholders and the executives that they hire to manage their capital. And of course, the agency conflict changes as the firm uses more financial leverage. So look at that last sentence. Debt holders will restrict the company's actions by having bond covenants. And so bondholders say something like, okay, I know that you've made me an explicit promise, but I know there are decisions that you can make out there that might, boy, can I use this term, expropriate wealth from the bondholders over to the shareholders. And so I'm going to require a sinking fund in there so that I can have a better guarantee of receiving my par value payment at maturity. Bankruptcy costs and flotation costs, these of course relate to things like the size of leverage, the relationship between leverage and assets inside of the balance sheet of a company. And of course, those firms that have lots and lots of debt have a greater risk of bankruptcy. Those firms that have lots and lots of debt and issue lots and lots of shares of stock will have to pay financing costs as well. Keep in mind, though, that the average float cost for a bond issue is substantially less than the average float for an equity issue. How about switching over to general economic considerations? So, of course, you would think that taxation would play a primary role here, general economic considerations. And that's why individuals and businesses and large corporations pay particular attention to Congress and their notions about taxes and tax rates and tax policy. But for our purposes here, what's important is that interest payments on the debt are allowed to show up on the income statement, which makes the tax liability less and makes the after-tax cost of debt more attractive relative to equity financing. Here, just remember this, that there's an interest expense on the income statement, but there's no such thing as dividends expense on the income statement. Inflation, expectations of inflation. This is super important. Of course, if we're expecting tons and tons of inflation, what we want to do as a business is issue a fixed rate bond and pay, let's say, let me pick a number, say 5%, and let's do this over 100 years. And then over the next time period, if inflation goes to, 8 or 10 or 12%, then we're better off. Now, of course, taxation and inflation are the results of some kinds of government policies. But in this context here, we want to make sure that you're aware that some government agencies exist to provide loans at lower interest rates than would happen in capital markets. And then finally, central banks may do something, how about if I use the term quantitative easing, so that in the United States, the Fed goes out and buys tons and tons of Treasury securities, tons and tons of mortgage-backed securities, and probably other securities out there, thus bidding up the price of those bonds, which will lower the yields on those securities. And the intent is to stimulate the economy. All right, how about we move on to the LOS regarding liquidity? So remember liquidity, remember where we are, top right, top left of the balance sheet. So we have all these things over here. Let's just call them accounts payable, which would account for everything over there that's due in the next year. How are we going to pay those things? Well, over here on the left-hand side of the balance sheet, we have things like cash, right, and marketable securities. And accounts receivable, oh boy, it'd be nice if we collected those accounts receivable so we could pay off our accounts payable, and then we have inventory in there. So liquidity, really, this is a working capital management issue. So let's read that sentence together. Extent to which a company is enabled to meet its short-term obligations using assets that can be readily converted into cash. Now remember, the accounting definition of insolvency simply means that something like the short-term payables exceed the short-term receivables, including cash in there. So what are the primary sources of liquidity? I just said these, right? Cash, short-term funds, and cash flow management. So remember, a company like Procter & Gamble is hopeful that those cash flows generated by the sales of all of its consumer goods flows in so that it can meet its payables in a timely fashion. So those are primary sources. Secondary sources are negotiations of debt contracts, liquidating assets. We don't want to do that. Filing for bankruptcy protection. We don't want to do that. All right, how about timing of receipts? Of course, what a business wants to do is pay its payables at the last possible moment until there's a penalty imposed, and collect its accounts receivables at the first possible moment, which is like immediately, right? So notice that sentence under the timing. Delayed receipts create pressure from the decreased available funds. So uncollectible, obsolete inventory, and tight credit. Timing of disbursements. So we've talked about this, right? Procter & Gamble up and down. So this creates what the reading calls a pull on liquidity, because the timing over here doesn't match the timing over there, making payments early, reduced credit limits, low liquidity positions. This is where the reading goes ahead and ventures off into what looks an awful lot like an accounting reading, and of course it is. What's that LOS tell us? Compare a company's liquidity measures to those of peer companies. So this is what I tell my students all the time. of course, as good financial managers, you're going to have to compute some kind of ratios. And remember, there are ratios that have to do with the balance sheet, which is what we're primarily concerned with here, but also balance sheet and income statement, and balance sheet and cash flow statement, and income statement and cash flow statement. And what we need to do is perform a trend analysis. So that's super important. See what has happened to each of these ratios over the last 5 years, and then compare that trend in addition to the current ratio to all of our peer companies. So here's some good ratios: current and quick ratio. These are pretty much the standard liquidity ratio. I ask almost every semester for my students to both calculate and interpret a current ratio. So current ratio is just current assets over current liabilities. And so this is a ratio that tells us, how much do we owe in the short term versus how much do we own in the short term. And the reading makes a suggestion of somewhere around 2 as a good current ratio. And I prefer to think of it as, do you have enough capital in the short term to make those short term payments? I ask my students about the risks associated with current ratios or any liquidity ratio being too high or too low. The risk of current ratios being too low is, of course, insolvency, which we just talked about. The risk of these current ratios being too high is something we call underinvestment. Suppose you had a current ratio of 20. That sounds like, oh man, we have tons of money to pay our current liabilities, but why would bondholders and shareholders pay executives to do something they can do on their own, right? What does that mean? Lots of cash, lots of marketable securities. Shareholders do that on their own without having to pay executives to do that. Now notice the quick ratio just subtracts out inventories, and so it's the same ratio. How about some turnovers? What do we want to do? We want our accounts receivable. We want to turn our accounts receivable over pretty quickly. So let's read that arrow point. Accounts receivable are created by credit sales and then collected during the fiscal period. And then inventory turnover, the inventory is created or acquired and then sold during that fiscal period. So these are kind of short-term activity ratios. And we'd like to be able to turn our inventory and our credit sales into cash as quickly as possible, which is why we then go ahead and compute number of days receivables, number of days inventory, number of days payables. And so let me swing back there. I would know these equations because you're going to have to know them at one point during level 1, 2, or 3. Know those equations and then know how to interpret them. Let's go ahead and look at that final LOS. Evaluate choices of short-term funding. Objectives of short-term borrowing strategy include a couple of things, but let's go ahead and compare it to how you probably run your household. I know I do. My wife and I, we have an investment in a money market mutual fund so that if we have a sudden cash need, we have access to that liquidity. Well, businesses are no different. So ensuring there is capacity to handle sudden cash needs. But let me go ahead and extend it to include something that might have an influence on future profitability. Suppose you're sitting at your desk as a good financial manager and this positive net present value project comes right in front of you. Wouldn't it be awesome if you had access to cash to be able to finance that positive net present value project? And remember, positive NPV projects, they can be super long term, which is what we discussed back in that previous reading, but they can also be short term in nature as well. Maintaining sufficient credit sources to fund cash needs. What this means is making certain that we have a relationship with our local financial institution so that we can pick up the phone and say, hey, Mr. or Mrs. Banker, we need a bunch of money and we need it today, right? Liquidity, that's super important here. And then, of course, if we manage the blue arrow and the green arrow point, then that probably means we're aware of current levels of interest rates and yield curves, and that we make certain that whatever vehicle we choose in the short term, that we've balanced the marginal costs and the marginal benefits, which means we're evaluating interest rates. Now, of course, some of these factors, and you probably would know these, let's go ahead and read through these: size and credit worthiness, that makes sense, legal issues, access to capital markets and access to financial institutions, and then the flexibility of borrowing options, right? If we need this cash, it would be nice if we had lots and lots of choices there from which to choose. And then we would be able to, boy, what does that say up top? Somewhere about cost effective. We'd be able to achieve that goal. And I think that takes us through those 4 learning objectives. I'm going to go ahead and just divide those by 4 and say, if you know each one of those 25%, that gets you good answers in this descriptive chapter.